Welcome back to the deep dive. If you've been tracking the trajectory of, decentralized finance and the traditional capital markets over the last year, we've passed a critical inflection point.
We really have.
We're not talking about hypotheticals anymore. We are talking definitively about real-world assets, or RWAs, and the industry consensus has completely shifted. The chatter is no longer, is RWA a buzzword, or is this actually going to happen? I mean, that debate is over.
It's completely over. Exactly. The shift is profound because the market has accepted the promise of RWAs, the fractionalization, global access, better settlement times.
Right.
But the core challenge has moved past theory and landed squarely on execution. It's now, how can we as institutions, as platforms, as DeFi protocols, efficiently get into the space and start building on reliable shared foundations? The fragmentation was just killing all the momentum.
And that inability to execute, right? The fragmentation is precisely what drove the creation of the material we are diving into today.
Yeah.
Our mission is to dissect the specific architecture designed to solve this exact problem, ERC 7943. It's a brand new tokenization standard, and the industry is already calling it the definitive game changer for institutional adoption.
It really needs to be, because the stakes are enormous. This isn't just another standard proposed by a single company trying to, corner the market.
Well,
It was developed by a large industry coalition. I mean, we're talking about a group that solicited input from over 50 to 60 companies globally.
wow.
Yeah, this includes the co-authors at Bricken, security experts like Hacken, white label tokenization platforms like DigiShares, and institutional partners like STO Box, and that's not even mentioning the major DeFi players like Zof. So we have insights directly from the people who wrote the standard and the people who are putting it to work right now.
Okay, so let's unpack this. The core issue that was plaguing RWA adoption, the one 7943 had to solve, was what?
It was massive data friction.
Right. And that friction, combined with vendor lock-in, frankly, it just killed institutional liquidity before it even had a chance to breathe.
It absolutely did.
We had older token standards, sure, ERC 1400, which focused on fungible security tokens, or ERC 3643, which had compliance features, but they were all siloed. They just weren't interoperable.
No.
Why was that lack of neutrality such a massive bottleneck for traditional finance?
It fundamentally comes down to trust, scale, and control. When you look at the previous standards, the critique from the institutional side was really sharp.
Okay.
They were often controlled to a great degree by a single vendor or were described as heavily opinionated in their design.
Heavily opinionated. What does that mean in practice?
It means the standard itself basically dictated how you had to handle compliance and identity.
Which is an instant turnoff for a bank.
Precisely. I mean, if you're a large global financial institution, adopting one of those older standards felt like you were signing an exclusive contract with a specific provider's entire ecosystem.
Their compliance tools, their identity registry.
Their preferred custody method, all of it. And that just doesn't scale for cross-industry, cross-jurisdictional use. You need the infrastructure to be a utility, something independent of the service providers who use it.
Right.
And the consequence was a total lack of the openness and independence needed for industry-wide adoption. Liquidity requires depth, and depth is just impossible if every asset is trapped on its own little technological island.
So let's start at the beginning of the solution then. Why couldn't the industry just adapt those existing standards? I mean, couldn't they have just forked 3643 and added some modularity? Why did Bricken need to start from scratch?
That was the initial thought process, but it quickly became clear that the legacy of control was just too deeply embedded. To get to true interoperability, to get to real scale, the industry needed a consensus that was fundamentally neutral.
Something that put everyone on an equal footing from day one.
Exactly. As the authors from Bricken described it, their aha moment wasn't really a technical realization, it was a market one.
How so?
Their own institutional clients felt locked out of certain solutions, or they just float out said that the existing opinionated vendor solutions were not possible for their big, high-volume use cases because they mandated too many specific components.
So the problem was more political and economic than it was technical. Institutions don't fear the technology. They're afraid of being locked in with one vendor.
Absolutely. Think of it like a global trade standard. You can't have one shipping company design the ISO container specifications and then charge everyone else high licensing fees to use their proprietary locks and customs forms.
Right. The standard has to be a public good.
It has to be.
That makes perfect sense. So what was the ultimate design goal for 7943 that addressed this massive institutional hesitation, this fear of proprietary walls?
The goal was defined by two concepts: minimality and adaptability. The standard had to be truly minimal, the smallest possible universal interface you need to define a security token.
Okay, so start with the bare essentials.
Exactly. This minimal interface needed to be universally usable across all EVM environments, but also inherently capable of escalating or expanding, depending on the complexity of the asset you're tokenizing.
So if you're tokenizing simple debt, it's just the basic functions.
Right. But if you're tokenizing complex equity with voting rights and dividend schedules, the standard allows for easy, standardized extensions to be added on top.
So it provides the skeleton, but allows the market participants to attach their own, highly specific muscle and organs.
That's a great way to put it. The core idea was to allow participants to adapt the standard for their specific needs, whether those needs are regulatory, technical, or specific to the asset type, without breaking that core standardized interface.
And that adherence to the core is what maintains the interoperability.
That's the key.
And that really is the crucial principle that ties back to the critique of the old system.
Yeah.
ERC 7943 had to be open, independent, and maybe most importantly, vendor neutral. It ensures that no single company benefits disproportionately from its popularity. Sounds fantastic in theory, but, that leads to an immediate practical challenge.
Which is?
Who pays for the continued maintenance and development of a standard that benefits everyone equally?
That is a critical question, and the answer is the coalition itself. Claus, the CEO of DigiShares, he highlighted this perfectly. He said previous standards lacked that neutrality, but this new standard puts all vendors on an equal footing.
And that shared ownership is the funding mechanism.
Exactly. The collective commitment of those 50 to 60 companies ensures its evolution. They realize that infrastructure is a collaborative effort, not a competitive one. If they all save money and gain liquidity by using a common standard, then funding the maintenance just becomes a minimal operational cost split across a massive ecosystem.
It fosters collaboration instead of competition.
Right. It changes the whole dynamic.
And the power of that coalition, it just speaks volumes. I mean, hearing that the co-authors got interest from over 50 companies, that proves this wasn't just a niche problem felt by a few. This was an industry-wide structural headache.
It was. Everyone felt the need to remove the silos and start working seriously on interoperability before the entire RWA movement just stalled out completely.
And that collective voice is absolutely vital for getting institutional buy-in. When a massive technology provider like DigiShares, they run a white label platform for over 200 clients globally, mostly in high-value real estate.
Huge player.
When they commit to implementing 7943 immediately, that signals major immediate market validation. They're moving their entire new client base onto this architecture.
It's a huge signal.
That leads directly to the practical real-world question for their existing users, though.
Yeah.
If clients are currently using older standards, like ERC 3643 or something even more bespoke, what happens to their existing tokens when DigiShares implements 7943? Does this move just create another new silo?
That's a very important point, and it reflects the thoughtful planning that went into this rollout. DigiShares has made it clear that existing clients can continue using their current standards.
So no hard cutoff.
No hard cutoff, no forced migration, which would cause chaos. However, all new clients will default to 7943 because it just offers demonstrably superior long-term interoperability and, less technical debt down the line.
But if existing clients stay on older, siloed standards, doesn't that just defeat the purpose? Won't 7943 just become the newest island in a sea of proprietary assets?
That risk is mitigated by the second half of their plan. They are actively developing the option for existing clients to migrate their assets to the new standard over time. So it's not a forced upgrade, but it's an incentivized one.
How is it incentivized?
The platform will make the benefits of 7943-like access to deeper liquidity pools, easier integration with DeFi primitives, so compelling that the migration becomes a natural economic choice for the asset issuers. It offers a smooth, non-disruptive transition path, which is just crucial for retaining institutional trust and making sure the new standard reaches critical mass.
Okay, let's dig into the technical elegance underpinning 7943. We hear the term interoperability constantly, but what does it mean mechanically here? How exactly is 7943 designed to be so interoperable, especially across the wider EVM ecosystem and with the DeFi infrastructure that's already out there?
So the core design philosophy centers on what they call retrocompatibility.
Retrocompatibility.
Yes. The standard doesn't try to erase or ignore the foundational work that came before it, the basic ways we trade, transfer, and own tokens in the Ethereum virtual machine. Instead, it makes itself compatible with the interfaces and function names used in established standards like ERC 20 for fungibility, ERC 721 for NFTs, ERC 1155, and critically, it adopts the compliance methods from previous regulated standards like ERC 3643.
So it's not reinventing the entire smart contract wheel, it's building a universal translation layer on top. It recognizes the common commands already in use and makes sure a 7943 token responds to them reliably, no matter what the underlying asset is.
Precisely. For a DeFi protocol or a DX or an institutional liquidity pool, the integration process becomes vastly simpler. They don't need to write custom wrapper contracts or adapters for every single RWA issuer.
They just need to understand one interface.
They only need to understand the single, neutral 7943 interface. And this drastically reduces the overhead to list a new tokenized asset, and that reduction in friction is the direct path to achieving broader liquidity across the entire EVM ecosystem.
That's the path to DeFi liquidity. But what truly satisfies the institutional players? This usually comes down to control over compliance. If the standard is meant to be universal, how does it handle the unique, often contradictory regulatory requirements of different jurisdictions?
This is the core architectural differentiator, and it's where 7943 really solves that vendor opinionation problem. It mandates a clear, inviolable separation between two critical elements: the interoperability layer, the token itself, and the compliance layer, the identity and access rules.
Okay, walk us through that separation. What does it mean in practice that these elements are modular?
It means the core token, the 7943 interface, only handles the transfer and fungibility logic, so it maintains its universal properties. The critical elements of compliance, things like KYC, AML checks, whitelisting addresses, identity registers, jurisdictional checks, all of that is abstracted out and managed by modular plug-and-play contracts.
So if a large bank in Germany needs to use their specific, audited, highly regulated KYC provider, and that provider uses a completely different on-chain identity schema than, say, a DeFi platform in Singapore, both can still plug their proprietary compliance stack into the same core 7943 token interface.
Exactly. The token itself doesn't care who validates the user, just that the validation function, which is defined by the 7943 standard, returns true before the transaction is executed. A platform can choose to plug in its own institutional compliance provider, its preferred attestation registry, or even a decentralized identity solution.
So that's the flexibility institutions demand.
It's everything. It gives them control over their regulated processes while guaranteeing that the underlying token still adheres to that core standardized interface. This choice prevents the standard from becoming heavily opinionated, directly solving the biggest complaint about the older, more monolithic standards, which tried to dictate the compliance vendor.
That's a really powerful framework for handling diverse regulatory environments without creating technological balkanization. It really is like standardized building codes. The foundation of the house, the core contract, 7943, is structurally sound and universally recognized.
Right.
But the specific safety features, like the fire alarms, emergency exits, the sprinkler systems, your KYC ML providers, those can be customized based on your location, your jurisdiction, and the specific needs of the asset or the regulator.
And that analogy holds up perfectly when we consider security, because standardization creates a collective defense. So let's transition to security, which is foundational to any institutional adoption. Hacken, a key compliance and cybersecurity partner, was heavily involved in reviewing the standards design. Their input was crucial.
What does the data tell us about where the threat landscape truly lies in the RWA space? I mean, where the actual vulnerability is concentrated?
Hacken shared some pretty sobering statistics from analyzing recent high-profile breaches. And while smart contract exploits like /loan attacks get all the headlines, the data shows that access control attacks dominate all other threat vectors in terms of funds extracted.
Access control attacks, so not glamorous code exploits.
Not at all. We're talking about basic but devastating key compromises, device compromises, social engineering attacks, and insider threats that give bad actors control over the private keys backing the assets or the protocol's admin functions.
So the biggest threat is governance risk and operational security, not necessarily a flaw in the token standard itself.
Precisely. They note that the high value and often slower development cycles of RWA protocols make them specific targets, and the cost of a hack like that often carries irreversible reputation damage that goes way beyond the financial loss.
Especially when you're trying to build institutional trust.
Exactly.
And when you have multiple non-standard RWA tokens floating around, each with its own bespoke approach to compliance and access control, what security gaps does that specifically create?
It creates a massive, unnecessary, and frankly unmanageable attack surface. Having multiple non-standard tokens, each built with a unique architecture, unique admin keys, unique compliance logic, it introduces hidden security risks and compliance gaps that are really difficult to monitor.
Because each one has its own unique vulnerabilities.
Yes, and smaller teams often lack the budget for full, comprehensive defense in depth across every single token they issue.
So standardization in this case isn't just about efficiency or liquidity, it's a massive risk reduction mechanism. It means that the best practices, the most audited access controls, are shared by default.
That's the idea.
So what does Hacken recommend as the security suite that should be embedded into or mandated alongside 7943?
They advocate strongly for a comprehensive approach they call defense by depth, which starts right with the infrastructure standard itself. This involves 3 mandatory layers.
Okay.
First, continuous security audits and design reviews. This isn't a one-and-done thing, it's a living process, which Hacken's auditors have already been contributing to. Second, and this is critical for trust, is mandatory proof of reserves attestation. They see this as an absolute must to ensure the underlying real-world assets are solvent and reliably backed one-to-one by the token.
Right, that addresses the classic worry. Is the thing the token represents actually real and there?
Absolutely. And third, they mandate post-deployment operational security measures. This includes running extensive bug bounty programs, often continuously, like their Dual Defense Initiative, and implementing real-time AI protection systems for continuous monitoring of transaction anomalies.
And what about the human element?
Critically, they stress that operational security at the team level, things like mandatory cold storage, multi-party computation for key management, using physically separate devices for work and personal life, that's the non-technical foundation. Because, as we discussed, access control is the biggest threat. ERC 7943 is designed to support these procedures, not get in their way.
It sounds like 7943 is embedding security and accountability standards right at the foundational layer, ensuring every issuer, big or small, benefits from a collective audited security consensus.
Now that we understand the robust architecture, the vendor neutrality, and the built-in security foundation, we can analyze who is adopting it and, more importantly, why it solves their specific pain points. Let's start with the institutional side, focusing on SPO Box, which specializes in turnkey tokenization for institutional clients and small and medium enterprises.
Right, for institutions, any adoption of a new standard has to be justified primarily by risk mitigation and cost efficiency. Why does 79943 matter so much to a traditional finance player like STO Box, whose business relies on that existing regulatory trust?
Well, institutions need infrastructure that is not only audited and scalable, but absolutely reliable. They have to be able to trust that the common protocol will enforce the necessary regulatory boundaries, even if they use their own proprietary tools internally. Jean from STO Box noted that 7900543 removes that inherent fragmentation and the risks that come with vendor dependency.
So it allows them to keep that essential control over their own regulatory features like their KYC/AML screening without losing the network effect of a standard token. And this standardization is crucial for solving the persistent challenges of cross-border RWA distribution, which is a regulatory and legal minefield. If I'm tokenizing an asset in Singapore, how can I ensure that only a properly qualified investor in Germany who's subject to EU rules can buy it? How does the standard ease this process?
This is where a deeply technical feature of the standard pre-transfer validation becomes a legal game changer. It's not just a nice-to-have, it's essential for global compliance.
Pre-transfer validation.
It's a mechanism that requires the smart contract to check the regulatory status of both the source and the destination of a token transfer before the transaction is allowed to happen.
Okay, walk us through a scenario.
Imagine a US-based tokenized bond offering. It's only allowed to be sold to accredited investors in certain states and, say, qualified investors in the EU. When a transaction is initiated, the token contract doesn't just check if the sender has enough funds. It pings the modular compliance layer, the identity register, and asks, is the sender authorized to sell this? Is the receiver authorized to buy this in their jurisdiction? Are they whitelisted?
And if any of those answers are no,
If the compliance contract returns a false, based on those encoded jurisdictional rules, say, the German buyer hasn't completed the necessary EU-mandated investor suitability check, the transaction just fails instantly, and it costs almost nothing.
so instead of waiting for regulators to harmonize global rules, which, let's be honest, could take decades, the standard provides a technical way to enforce localized rules globally and prevent bad transactions from ever settling.
Exactly. This functionality helps encode those highly fragmented jurisdictional rules right into the asset's lifecycle. The standard acts as a universal interpreter for fragmented global law.
That makes the tokenized asset superior to a traditional paper security, simply because the compliance is active and automated, not passive and dependent on manual audits later.
An STO box emphasizes that this is the goal, making tokenized assets superior to traditional securities. They achieve this not just through compliance, but through data richness. They aim to embed real-time, up-to-date performance data into the token itself using oracles, giving the investor a far richer, more current picture of the underlying asset.
That's a truly powerful value proposition. Now, let's look at the other side of the coin, the DeFi imperative. We have Zoth operating at that critical intersection of RWA and DeFi. For them, what is the biggest pain point that 79043 addresses?
For Zoth and other DeFi protocols, the biggest challenge isn't the mechanics of tokenization, it's the availability and integration of crypto liquidity for RWA assets.
Right.
Freedom from Zoth noted that too many RWA announcements focus solely on getting the thing on-chain, but they completely fail to address adoption and connecting those assets to the users who have the liquidity. If the asset is tokenized but can't be easily used as collateral or traded efficiently, the whole exercise is pointless.
So older, bespoke RWA tokens were essentially stranded assets because DeFi protocols couldn't trust their compliance or integrate them easily into standard operations like lending pools.
Precisely. The standards were too varied, and the compliance requirements were often opaque or inaccessible to the permissionless side of DeFi. Zoth built its core structure with a compliant, regulated reserve base. But on top of that, it needs a scalable, permissionless layer to interact with the broader crypto market.
And ERC 7943 is that permissionless layer.
It forms the core of it. Its modularity and its vendor-neutral interface reduce friction and prevent the formation of those liquidity islands where assets get trapped. Because 79043 tokens follow a known, audited standard interface, it enables Zoth to easily integrate diverse tokenized assets, from U.S. Treasury bills and corporate bonds to money market funds, into its cross-chain lending and borrowing protocols.
So without a unified standard, you can't even build basic DeFi primitives. How does standardization enable something as simple as a reliable price oracle, for instance?
Well, if every tokenized asset has a different way of representing its value, its settlement mechanism, and its compliance status, a price oracle has to be custom built and maintained for every single one. That's costly, risky, and slow.
A nightmare to scale.
A total nightmare. By standardizing the interface, 79043 allows for the creation of consistent price oracles and, critically, instant settlement layers across all these disparate tokenized assets. The standardization provides the predictability that smart contracts need to automate complex financial functions, like automated liquidations or cross-chain collateralization.
It simplifies the infrastructure layer so they can focus on scaling the adoption layer.
Exactly. As Prudham pointed out, their competition isn't other tokenization platforms. It's the inefficient fiat rails and the lack of standards that stifle growth across the entire sector. The focus has to be on simplifying the technical infrastructure to drive mass adoption and unlock all that crypto liquidity.
This brings us to the long-term vision, which is maybe the most exciting and radical part of this analysis. We're talking about transforming the fundamentals of finance. Claus from DigiShares discusses a fascinating perspective, that tokenization will cease to be a product or application that people even talk about.
Yes. The long-term vision is that tokenization will become the underlying infrastructure of the financial industry. He compares this evolution to the rise of Amazon Web Services for corporate IT.
Right. Nobody talks about the AWS cloud infrastructure running Netflix or Uber.
Exactly. It's just the invisible, dependable engine running everything in the background. Tokenization will eventually become the default issuance and settlement engine for all capital markets.
That's a significant infrastructural overhaul, suggesting a long integration timeline. I mean, it took decades for things like modern electronic stock trading or even the concept of REITs to become fully embedded and trusted.
Certainly not overnight. It will take years, possibly a decade. But the key to success, according to this vision, is that tokenization must successfully plug into the existing, highly trusted regulatory and financial system. It can't be a parallel system. It has to be the upgraded version of the current system.
And this leads to a truly radical concept about how the traditional players, the global banks, will have to evolve to survive.
It does.
What is the bank's new role in this tokenized future, where trust and transparency are managed by standardized code?
Banks will transform their function entirely. They will evolve into sophisticated digital network operators. They'll still maintain the essential functions of trust, regulation, and custody, but their primary interface will shift. They will implement crypto wallets as a natural extension of standard accounts.
So my bank account, instead of just showing me a balance in fiat currency, will be a seamlessly integrated custodial wallet.
Precisely. Users will be given direct, intuitive access to invest and transact in tokenized assets, but these assets will be presented simply as standard shares, bonds, or stocks in their app without them needing to understand blockchain acronyms or standards like ERC 7943.
The underlying technology becomes invisible.
Completely invisible. The user can, of course, opt for self-custody if they prefer, but the distribution rails of the traditional financial industry will simply be upgraded and connected to this standardized tokenization layer.
That is how you get to true, quiet mass adoption, making the infrastructure invisible and integrating it into trusted interfaces. Now let's explore the advanced, complex use cases unlocked by this level of standardization. We are talking about RWA-backed DeFi moving beyond simple fixed income.
Absolutely. The foundation is already being laid. We're seeing major movements in tokenizing loans and highly liquid, low-risk treasury bonds. But the real synergy is using RWA assets that are compliant and regulated thanks to 7943's structure as collateral in sophisticated DeFi products, specifically CDP or collateralized debt position structures.
Okay, that moves beyond passive yield generation. That is using the embedded liquid value of a regulated asset as dynamic leverage within a permissionless ecosystem.
Yes. And while this starts with the most liquid and easily valued assets like T-bills, the ultimate vision is to expand to assets that are currently illiquid, like real estate. Preetam from Zoth described the ultimate use case, which makes this abstract idea concrete.
Let's hear it.
Imagine using RWA collateral, say 100 fractionalized shares of an apartment in Dubai, or a tokenized portfolio of corporate bonds, and linking that collateralized value to a payment stack or a card for instant day-to-day purchases, like buying a coffee.
Wait, I need more detail on that. How does that work? I don't liquidate my apartment shares to buy coffee, right? I'm leveraging the value of the RWA.
Correct. The RWA serves as dynamic, real-time collateral in that CDP structure. Instead of selling the shares, you lock them into a vault. A standardized oracle enabled by the 7943 architecture continuously monitors the market value of that RWA collateral.
And I can borrow against that value?
You can then borrow against that collateral, usually in a stablecoin, and use that stablecoin to fund your payment card. Because the underlying RWA is tokenized on a standardized protocol, its status, ownership, and value are instantly verifiable, allowing for instantaneous credit checks and settlements.
It makes that collateral liquid and usable for daily financial flows.
This is how RWA moves beyond just an investment product and becomes an integral part of global financial plumbing.
That paints a powerful picture of an accessible, highly flexible financial future where value doesn't sit dormant, but is dynamically accessible. But to achieve that, we need the entire industry, including the traditional giants, to fully adopt this standard.
That's the critical final step. The collective voice of those 50 to 60 companies supporting 7943 provides that necessary weight. It's what's needed to convince large institutions to abandon their proprietary legacy systems and move to a unified, open protocol.
But even with this momentum, there have to be hurdles remaining.
Oh, absolutely. There are two major hurdles that the industry still has to address.
Okay, what are the primary hurdles for achieving truly mass adoption?
First and foremost is regulation, specifically the regulation concerning the secondary trading of these assets, particularly on decentralized exchanges or DX markets.
Right.
Tokenization can't fundamentally change the legal nature of the financial instrument. If a tokenized security is not legally freely tradable due to investor eligibility rules or geographical restrictions, it can't just be placed on an open, permissionless market without potentially violating securities laws.
So even with pre-transfer validation, there are still legal gray areas on the secondary market that need to be resolved. What about the second major hurdle?
Market education and user experience. This loops right back to the idea of tokenization fading into the background. The technology needs to be as easy as possible. The end user should not need to understand blockchain acronyms, gas fees, or standards like ERC 7943. They should use the product as intuitively as a child uses a streaming service without needing to know anything about the underlying networking protocols.
Just make it simple.
The focus has to be on simplifying the infrastructure to a point where the user experience rivals, or ideally surpasses, traditional banking apps.
And finally, based on the coalition's current progress and the EIP process, when is this foundation expected to be finalized and ready for widespread adoption?
The standard is currently in development, undergoing rigorous audit and review within the Ethereum community forums, with the expectation that it will be fully finalized, audited, and ready for mass implementation by platforms like DigiShares and STO Box by early 2026. So that gives institutions a clear runway to integrate.
This has been a critical deep dive into the blueprint of the future financial system. What we've learned today is that ERC 7943 is not just an incremental improvement. It's a foundational solution designed to eliminate industry silos, ensure vendor neutrality, and provide a scalable, secure compliance framework that global institutions absolutely demand.
The key architectural takeaways here are clear and powerful. We're seeing the definitive separation of the compliance and interoperability layers, which is crucial for regulated adoption at scale. The standard's focus on deep liquidity through retrocompatibility ensures that tokenized assets won't be stranded. And the long-term vision is compelling, that tokenization will soon become the invisible, trusted infrastructure of global capital markets.
This standardization is the moment where real-world assets stop being an isolated proprietary experiment and start becoming a cohesive, scalable ecosystem, unlocking complex use cases like dynamic RWA-backed collateral for daily life.
And this all builds toward a future where your relationship with your primary bank fundamentally changes. We've discussed that banks will start implementing wallets as a natural extension of accounts, and that real estate and bonds can be used as collateral linked to payment cards for day-to-day spending. Considering the speed and the consensus shown by the coalition behind ERC 7943, I want to leave you with this question to think about. If banks are already pivoting to become digital network operators and this standardization is paving the way, how soon until your current traditional bank account completely evolves into a seamless hybrid RWA DeFi wallet? That infrastructure shift is a lot closer than most analysts realize.